In 1929, the world discovered how fragile prosperity really is. What looked like unstoppable growth collapsed almost overnight. Markets that had climbed for years suddenly fell apart. Wealth that took lifetimes to build disappeared in days. Banks shut their doors. Savings evaporated, and ordinary people paid the price for a system they barely understood. Over time, this moment was framed as a tragic exception, a historical accident buried safely in the past. But history has a habit of returning when its lessons are ignored. The uncomfortable possibility is that the forces behind that collapse never vanished. They adapted. And today, they may be shaping the economy you live in right now. When people struggle to understand why everyday life feels more expensive, why owning a home feels increasingly impossible, or why debt keeps growing faster than income, they often blame isolated events. But these pressures are rarely random. They tend to emerge from deeper structures built over decades. Long before 1929, the warning signs were visible to those willing to look. Confidence replaced caution. Borrowing replaced earning. Speculation replaced production. The surface looked strong, but the foundation was brittle. In the years leading up to the Great Depression, optimism was everywhere. Stock prices rose so consistently that decline felt impossible. Ordinary citizens, not just professionals, poured money into markets using borrowed funds. Buying on margin became normal. Newspapers celebrated a future of endless growth. Technology promised efficiency. Politicians reassured the public that the economy had entered a permanent golden age. Underneath that confidence, however, debt piled higher and higher. Prosperity depended less on real income and more on belief that prices would always rise. Speculation did not stop at stocks. Real estate surged. Banks loosened standards. Businesses exaggerated earnings. Consumers bought goods they could not afford using installment plans. The entire culture leaned toward optimism fueled by credit. This pattern has appeared repeatedly across history. Debt-driven booms feel powerful, inclusive, and permanent, yet they always rely on one fragile assumption: that tomorrow will be richer than today. When panic finally arrived in October 1929, it spread with astonishing speed. Investors rushed to sell. Prices collapsed. Paper wealth vanished almost instantly. But the crash itself was not the true disaster. It merely exposed weaknesses that had been building for years. The deeper failure lay in an economy stretched too far by leverage, inequality, and unrealistic expectations. The system did not break because people panicked. People panicked because the system was already unsound. That distinction matters now more than ever. Financial crises rarely begin with a single event. They begin with structures that cannot withstand stress. When trust disappears, borrowing halts, spending freezes, and confidence collapses. That chain reaction defined the Great Depression. It also defines the risk modern economies face today. The tools have changed, but the behavior has not. Instead of ticker tapes and brokers shouting on trading floors, markets now move through apps and algorithms. Instead of margin loans, households rely on credit cards, mortgages, student debt, and government deficits measured in trillions. Consumption remains the engine of growth, and consumption still depends on confidence. When belief fades, the entire machine slows. Debt sits at the center of this story. In 1929, American households carried unprecedented levels of personal debt. People assumed rising wages would make repayment easy. Today, global debt exceeds several times the value of all goods and services produced worldwide each year. Governments, corporations, and individuals all depend on borrowing to maintain stability. The numbers differ, but the logic is the same. We continue to spend future income to sustain present lifestyles. Inequality deepens the risk. Before the Great Depression, wealth concentrated heavily at the top. A small elite benefited most from rising asset prices, while the majority relied on wages and credit. When the crash came, those without assets had nothing to fall back on. Today, wealth concentration is even more extreme. Asset inflation rewards those who already own property and investments. Wages struggle to keep up. The middle class increasingly relies on debt to maintain living standards. This imbalance strains both the economy and social trust. Central banks now face dilemmas eerily similar to those of the late 1920s. Low interest rates encourage borrowing and asset growth. Higher rates slow inflation, but threaten stability. Policymakers know that either choice carries consequences. In the past, sudden tightening helped trigger collapse. In the present, prolonged intervention risks creating bubbles too large to deflate safely. History is not repeating exactly, but it is following familiar rhythms. Speculation also remains constant. In the 1920s, People invested in companies they barely understood simply because prices kept rising. Today, speculation appears in new forms, from volatile tech stocks to digital assets. The underlying psychology has not changed. Fear of missing out replaces careful analysis. Rising prices feel like proof of intelligence. Falling prices reveal how much depended on luck rather than insight. What the Great Depression ultimately revealed was simple and unsettling. Systems overloaded with leverage and inequality cannot sustain themselves indefinitely. Confidence hides fragility, but it cannot eliminate it. When belief breaks, adjustment follows. The scale of today's financial system makes this risk larger, not smaller. Markets are global. Capital moves instantly. A failure in one region can ripple across continents within hours. The collapse of the early 1930s was not only financial, it was social and psychological. People lost faith in institutions they had trusted. Governments struggled to respond. Early policy choices often worsened conditions by prioritizing short-term stability over long-term health. Unemployment soared. Economic pain reshaped politics and society for generations. Modern responses differ in form but not always in spirit. Today, crises are met with liquidity injections, bailouts, and reassurances. These measures calm markets temporarily, but they rarely address structural causes. Debt continues to grow. Risk remains mispriced. Losses are postponed rather than resolved. Each rescue plants the seeds of the next crisis. Leverage still amplifies danger. In the past, margin loans forced investors to sell when prices dipped. Today, leverage hides within complex financial instruments and interconnected institutions. Small disruptions can escalate quickly. Models built on assumptions fail when reality diverges. Transparency declines as complexity increases. The system becomes harder to understand, even for those managing it. Trust remains the fragile core. In the 1930s, bank failures shattered confidence overnight. Safeguards introduced later restored stability for a time. But today's system is larger and more intertwined. Fear spreads faster. When institutions wobble, reassurance must compete with instant information and rumor. Confidence, once lost, is difficult to rebuild. Perhaps the most dangerous parallel lies in belief. Before every major collapse, people feel safest. Progress appears inevitable. Warnings are dismissed as pessimism. Those who urge caution are marked for missing out. This mindset dominated the late 1920s. It exists again today. Technology and policy foster the illusion of control, but no system escapes economic reality forever. The Great Depression reshaped the world. It forced reforms, regulation, and social safety nets. It also taught governments how powerful intervention could be. Over time, emergency measures became permanent expectations. Markets learned to assume rescue. Risk became socialized while rewards stayed private. This shift altered incentives and deepened dependence on intervention. Inflation now plays a quiet role. To avoid deflationary collapse, modern economies tolerate rising prices. Inflation eases debt burdens, but erodes savings. It transfers wealth subtly from cautious savers to borrowers and asset owners. Stability relies on this trade-off. When inflation accelerates, trust weakens. When it slows too much, debt pressures rise. Balance becomes increasingly difficult to maintain. Global interconnectedness magnifies every mistake. A policy change in one country affects markets worldwide. Capital flows amplify both optimism and fear. The same structures designed to spread growth now spread instability. The speed leaves little room for correction once momentum turns. Economic distress also shapes politics. The Great Depression fueled extremism, protectionism, and conflict. Economic insecurity erodes faith in institutions and cooperation. Similar tensions are visible today. Distrust grows. Polarization deepens. When people lose confidence in opportunity, they search for control wherever they can find it. Despite these echoes, history does not demand repetition. The warnings are visible. Unsustainable debt, inflated assets, widening inequality, and overconfidence have appeared before. The challenge lies in acting before collapse, rather than reacting after. That requires discipline, honesty, and willingness to accept short-term discomfort for long-term stability. One lesson from 1929 stands above the rest. Denial delays recovery and deepens damage. Early signs were dismissed. Leaders reassured, instead of confronting reality. By the time acknowledgement came, the system had already fractured. That psychology remains timeless. Comfort often wins over correction until options vanish. Today's economy stands at a familiar crossroads. Growth slows, debt climbs, inequality strains trust. Technology accelerates every cycle. The pattern is old, even if the tools are new. The ghost of 1929 is not confined to history books. It appears whenever speculation replaces value, whenever borrowing replaces earning, and whenever confidence replaces caution. The question is not whether collapse must happen, but whether lessons can be applied before it does. History offers insight, not destiny. Whether the coming years repeat the past or break from it depends on choices made now. Awareness is the first step. Ignoring echoes has never silenced them.